I am OG John Original. Tonight, a convergence of developments across global commodities markets, geopolitical flashpoints, and financial exchanges is painting a complex picture for investors and analysts alike. From a significant reduction in precious metals margin requirements on the Chicago Mercantile Exchange, to accelerating drawdowns in physical silver inventories, to escalating military activity in the Middle East, the scope of tonight's report is broad, and every element is connected. We begin with what market observers are calling a notable shift in exchange policy. The Chicago Mercantile Exchange has cut margin requirements across multiple precious metals futures contracts, effective after today's market close. Gold futures margins have been reduced from 9% to 7%. Silver futures have seen a more substantial cut, dropping from 18% to 14%, a reduction of approximately 22% in a single move. Platinum margins were also trimmed by 13%. This decision follows 6 consecutive margin increases that were implemented during the recent metals rally. Those prior hikes had the effect of reducing open interest, lowering trading volumes, and pressuring leveraged long positions out of the market. Now, with physical silver inventories at what analysts are describing as critically low levels, and squeeze pressure in the physical market reported to be at its highest point in years, the exchange has moved in the opposite direction, making participation in these contracts less costly. The timing of this policy reversal, coming precisely when physical market stress is most acute, is what is drawing scrutiny from market participants. Whether the cut is intended to attract paper traders back into a thinning market, or whether it reduces the cost of maintaining short positions during a period of elevated squeeze risk, the data that follows this decision, particularly positioning reports, will be closely watched. Registered silver inventories, meanwhile, continue to decline at an accelerating pace, a development we will break down in full detail. Turning now to the physical silver market, where the latest Wednesday inventory report has added significant weight to an already strained supply picture. According to the most recent data, approximately 6 million ounces of registered silver were adjusted out of the system in a single session. That movement was recorded simultaneously across 7 custodial facilities: Asahi, Brinks, CNT, Delaware, HSBC, Lumis, and StoneX, all in a single night. Registered silver inventories have now fallen to approximately 81,235,000 ounces. Earlier in the same trading day, that figure stood at roughly 87 million ounces. That represents a decline of nearly 6 million ounces of deliverable silver within a single session. Importantly, the rate of this drawdown is not stabilizing. By the available data, it is accelerating. Adding to this, withdrawal data from the Shanghai Gold Exchange shows silver withdrawals running at nearly 3 times the level recorded in the same period 1 year prior. That figure is not attributed to seasonal variation or statistical rounding. It represents a sustained and significant increase in physical demand out of one of the world's largest metals exchanges. On the positioning side, managed money long exposure to silver is currently reported to be at a 2-decade low. This is occurring against a backdrop in which silver prices moved from approximately $30 to over $120 during the current cycle. Despite that price appreciation, money managers reduced their long exposure by approximately 70% across that same period. Simultaneously, the physical silver market has recorded a structural supply deficit for 5 consecutive years. The divergence between paper market positioning, which is at its most bearish in 20 years, and physical market demand, which is described as the tightest it has been in a decade, represents what analysts are characterizing as a significant structural setup. The COMEX gold-to-silver inventory ratio has now declined to 1 to 10.7. The gold-to-silver price ratio currently stands at 61 to 1. On the broader paper leverage question, for every single ounce of physical gold held in deliverable form, 133 ounces of paper gold are reported to trade against it. That 133 to 1 ratio provides important context when sharp moves in paper gold prices occur without a corresponding move in physical gold values. We turn now to gold price action, where a pattern in trading activity this week has attracted considerable attention. For 4 consecutive trading sessions, gold experienced sharp sell-offs triggered at precisely 8 o'clock in the morning Eastern Time. On Monday, gold declined by nearly 3%. On Tuesday, the decline exceeded 4%, bringing prices back to the $5,000 level. Wednesday saw a drop of nearly 2%, followed by another 2% decline on Thursday. Across those 4 sessions, approximately $4 trillion in paper gold value was erased. Market analysts observing this pattern note that natural selling activity does not consistently trigger at the identical minute across 4 consecutive trading days. The pattern carries what is being described as a mechanical signature consistent with algorithmic execution. The name of financial firm Jane Street has been cited in connection with this pattern. The Commodity Futures Trading Commission has not publicly commented on the matter, and market observers are noting the absence of a public regulatory response. Against that backdrop, global gold exchange traded fund data presents a contrasting picture. Gold ETFs recorded net inflows of $5.3 billion in February, marking the 9th consecutive month of net inflows and the strongest start to a calendar year on record. Total global assets under management in gold ETFs climbed to a record $71 billion, with total holdings reaching 4,171 tons globally. Institutional allocation into gold is, by these figures, continuing to grow while paper price action moves in the opposite direction during specific trading windows. On the silver spot market, Western spot silver is currently trading at $82, with futures at $83. Shanghai spot silver is priced at $93, with futures at $95, representing an $11 premium over Western futures pricing. Silver pulled back to $80 before recovering to $83. The near-term picture on shorter timeframes is described as unclear ahead of Friday's non-farm payroll data release. The US dollar index is consolidating ahead of that release. A close above the January 15th level on the DXY following the NFP report would present additional downside pressure for paper metals prices. A failure to hold that level would alter the near-term outlook. Equity markets are also under pressure. The S&P 500 declined 1.44%. The Nasdaq fell 1.64%. The Dow Jones Industrial Average dropped 1.69%, and the Russell 2000 declined 2.45%. Bitcoin also moved lower. Nearly $1 trillion in combined equity market value was erased since the open. The geopolitical situation in the Middle East represents what is now being described not as a background variable, but as the primary market driver. Iran has launched its 20th wave of strikes, involving ballistic missiles and drones targeting United States and Israeli positions. Iran's foreign minister stated publicly that the country has long been prepared for this conflict. When asked by a reporter whether he feared a United States invasion, the foreign minister's response was that they are waiting for them. Russia has since stated it will do everything possible to make a United States and Israeli military operation against Iran impossible. The financial cost of the ongoing conflict is significant. Israel is reported to be spending $3.7 billion per week. Kuwait has suspended oil refining operations following the closure of the Strait of Hormuz. Iran has formally rejected both ceasefire proposals and negotiations with the United States. On the cost side, a $20,000 drone has been reported to require between $16 and $20 million worth of Patriot missile interceptors to neutralize. United States and Israeli officials have already been reported as considering a reduction in attack frequency due to declining weapons stockpiles. The total cost over 6 days has reached $5.4 billion, representing approximately 26% of Iran's entire annual military budget. The Pentagon's stated timeline for the conflict has been revised on multiple occasions. Initial projections described a short engagement measured in days. That was revised to 4 weeks, then to an open-ended duration, and most recently to a timeline extending through September. Each revision has moved in the same direction: longer, more costly, and with greater uncertainty attached. Oil markets have responded accordingly. Brent crude closed at $85.41, up nearly 5% on the session. West Texas Intermediate closed at $81, up 8.5%. Oil has already moved from $55 to over $80, a move that analysts estimate adds approximately 50 basis points of inflation pressure, pushing estimated CPI from approximately 2.4% toward 3%. At $95 per barrel, the estimated CPI impact rises to 3.2%. The United States Treasury is reported to be considering intervention in the oil futures market to control rising energy prices. On the bear case for metals, silver's pullback to $80 and the recovery to $83 have left shorter time frames without a clear directional signal. Dollar consolidation ahead of non-farm payroll data introduces resolution risk in either direction. The CME margin reduction could lower the cost of holding short positions into a major data release. Open interest remains at decade lows, meaning price can move sharply in either direction on limited volume. On the structural side, physical silver market deficits have persisted for 5 consecutive years. SGE withdrawals are running at nearly 3 times year-over-year levels. Registered COMEX silver has declined to 81,235,000 ounces, with the drain accelerating. The gap between paper market positioning and physical market conditions continues to widen. That concludes tonight's full market and geopolitical briefing. For independent verification, the COMEX inventory reports and CME margin announcements are publicly available for review. This has been your evening market report.